guys, welcome back to another video. So I know that I missed last week's market update and forecast, so we do have a little bit of catching up to do. Let me tell you, the market is interesting, and for a lot of you, I'm going to be the bearer of many good news finally, which makes me happy as well. Many of you guys know that I absolutely hate delivering crappy news. Now, if you're new to my channel, welcome. I teach about the trucking industry with a heavy focus on the spot market as well as freight market analysis. So if this is a topic that interests you, feel free to subscribe down below. I just realized I have a twin over there. Hi! All right, enough horsing around. A reminder, this Sunday at 4:30 p.m. Eastern Time, I'm doing another live Q&A about the trucking industry and the freight market. So if you have any questions, you know where to find me. Anyway, guys, let's go ahead and take a look at what is going on in the freight market. Ready? Let's go. All right, guys, as always, we're going to look at the general freight market situation, and then we're going to look at how it's affecting the spot market and then specific equipment types. So we're going to start with the outbound tender volumes versus outbound tender rejections again. As a reminder, the blue line, outbound tender volume, shows us the total freight in the market. How much demand is there from shippers? The higher the volumes, the more demand, the better for us. The white line shows us tender rejections. How many contract carriers or how many loads are getting rejected by those contract carriers and therefore getting sent to the spot market? I nearly lost my pen, you didn't see that. So how many loads are getting sent to the spot market? Usually, the higher the tender rejection, the better for us spot carriers, because that means more volume is getting pushed into the spot market. So this is from the end of February until right now, well, as of July 6th. And we can see that in the beginning of July, volumes, they plummeted down. Do you see that? They plummeted down. Now, this is normal. This is because of the holiday. Now, currently, we can see we have a little bit of hope. The volumes are starting to go up a little bit. We'll see what happens in the next week or so. Volume should start picking up, obviously. Now, tender rejections, as you can see, from around the beginning of June, tender rejections have been climbing pretty much non-stop. And of course, they plummeted down together with volumes, which is normal. Usually, when the volume drops drastically, it takes the tender rejection down with it. So currently, the tender rejection rate is at 3.52, which means that 3.52% of loads are getting rejected and therefore probably ending up on the spot market. This is a very low number, but if we look at it relatively, this is much higher than we have seen in a while. We have been bouncing on the 2%, the high 2% level for a while. So 3%, it's like a breath of not fresh air, but a little bit of oxygen. Okay, now we have this chart. This is the National Truckload Index for line haul only. As a reminder, the NTIL, this index, this is based on dry van data, and it shows us the average spot rates without fuel surcharge. Now, this is a seasonal chart, so we can see that all the different colors, they represent the different years, right? Green is 2022, well, blue is 2021, but it's also this year. We will look at it right now. So yeah, to give you an idea, this is 2021, and this is us right here, right now. So what we can see is that as of July or towards the end of June, the NTIL, the spot rates without fuel surcharge, they increased. Why did they increase? Well, first of all, because seasonally, we can see it increases every single year. Why does this happen? Because tender rejections tend to increase every single year around this time. And as I said before, there is a strong correlation between tender rejections and spot market rates. Why is that? Well, it's pretty simple. As more freight gets rejected, more volume ends up on the spot market. The more volume on the spot market, the more that load to truck ratio starts tipping in the carrier's favor, because it starts soaking up that capacity. And as that capacity is being soaked up, the rates on the spot market start increasing. Now, currently, the NTIL, or the spot rates without fuel surcharge, they're at $1.72 per mile, which is really low, especially considering that the cost of operating a truck is very often higher than this. It just came out that in 2022, the cost of operating a truck was around $2.25 per mile. Now, obviously, fuel and diesel prices have gone down since then, but the price of everything else is pretty much still elevated. I mean, I complained to you guys about the repair expenses. So yeah, the cost of operating a truck is still very high. So this just doesn't cut it, but at least it's on its way up. So now we have the contract to spot spread, and we can see that the gap has been increasing. Spot rates pay on average 77 cents less per mile than contract rates. So unfortunately, this is not great. Again, the gap is increasing. We need it to decrease. Okay, let's take a look at the spot market. So as a reminder, this chart is by FTR Intel. And the blue bar graph, this is us right now, and this is divided into weeks. So we're looking, the latest data is from last week. The black line, this is the 5-year average, and the orange and green line is 2022 and 2021. So this is the total spot loads. How much volume is there on the load board, on the spot market? And we can see that the volumes did increase slightly. The reason the increase is so small is because of flatbeds, and we're going to get into that in just a couple of minutes. Flatbeds are kind of skewing the total load volumes and rates because flatbeds are not doing well right now. But yeah, the volume still did increase, which is a really good sign for the spot market. We want volumes to keep increasing. Now, what about spot rates? And this is the same exact chart. We can see that we have been trending above more or less the 5-year average until about 4 weeks ago. And currently we can see that spot rates, they actually decreased very, very slightly on the spot market last week. So I'm sure you guys will be wondering, what the heck? You just said the tender rejections are up, the spot rate should increase. Well, they did. We're going to see that when we look by equipment type. The reason the spot rates decreased here is because of flatbeds. Flatbeds are currently in free fall, but as we will see, reefers and dry vans are getting some relief right now. Okay, finally, before we actually move to the equipment specific data, let's take a look at diesel prices. This is diesel truck stop actual price per gallon. For those of you who are new, I get these charts from Sonar. Just so you know. And I'm going to attach pictures of these charts down below so that you guys can actually access them and see these charts a little bit closer. Diesel prices. Diesel prices, this is as of the beginning of the year, but currently we can see we plateaued in the past couple of days, but we're still on our way down, which is awesome. The average price per gallon is $3.89 per gallon. Great stuff. Now, if we look at this chart, we can see that pretty much everything except for Minnesota is red, which means that pretty much in every market, diesel prices are decreasing. There was a moment where the diesel prices were increasing in a lot of markets. This chart was kind of getting too green for my taste, but currently we're doing well. Diesel prices are dropping. All right, let's look at equipment specific data. Flatbeds first. And as I said, flatbeds are deteriorating. So let's take a look at what's going on with spot loads, volumes on the spot market. As you can see, volumes they're just in free fall. And this is what is dragging those total spot volumes and total spot rates down. We'll see the rates in just a minute. The worst part is that, I mean, a decrease right now, it's normal year after year and according to the 5-year average, as we can see. The question is, will it experience any increases or will it continue going down? Now let's take a look at spot rates. We have been above the 5-year average for pretty much the whole year so far until 3 weeks ago, and currently, again, flatbed rates on their way down, and they're not even following the 5-year pattern anymore. So when you look at those total spot rates and you see that spot rates decreased, it's because of the flatbeds. The flatbeds are skewing the data because of how much the market is deteriorating for flatbeds. So what in the world is going on here? Let me read this to you. According to DAT, 25 to 30% of lumber comes from Canada for consumption in the US. And with the wildfires, millions of acres were destroyed. So this could be partially the reason for the lack of volume and for the crash in rates, but this is just, I think this is a small part. Another big thing is that a lot of dry van operators are now turning to flatbeds because they're hoping to make more money on the flatbed market. But we soon will see that they actually don't need to turn to the flatbed market because dry vans are improving. All right, let's take a look at these charts by truck stop of what states have the best potential for flatbeds. So what we are looking at is we're looking at flatbed, and flatbed here we have number of loads picking up versus number of loads dropping off. To translate it, volume from this state versus trucks in this state. What we need is more volume than trucks. In the western states, California, Nevada, Oregon, Washington. Reminder, if you are in the West Coast, the best rates will be from West Coast to West Coast, so be careful. In the plain states, it's only Kansas, which is the first time I see that, but if you look at it, it's just slightly higher, the volume, than the number of trucks. In the Midwest, Illinois, Indiana, Kentucky. Southern states, pretty much everywhere except for Tennessee. And then we have the northeastern states, Delaware and Maryland. Okay, let's take a look at a map that's going to show us the same thing. It's not the map that I usually show you. This is the map from the DAT load board. So what we're looking at is capacity. If the area is bright red, that means it's very tight capacity. Way more loads than trucks, good negotiating power. The bluer an area is, the looser the capacity. There are way more trucks than there are loads. So we can see, of course, the south is where the capacity is pretty tight. There are places in Oregon and Central California, even in Arizona, which is interesting. The question is, where do these loads go? What kind of lanes do they offer? We have places in the Midwest as well, Virginia, South Carolina, portions of Pennsylvania, the plain states, Wyoming, Colorado, New Mexico, Nebraska, all of that, it's blue, which means that there's very loose capacity. There are way more trucks than there are loads, so no negotiating power. So yeah, this is what it looks like for flatbeds. All right, now on to dry vans. And as I said before, this is the spot loads. How much volume is there on the spot market for dry vans? We can see that for the past 3 weeks, they have been improving. We have been growing in terms of volume for dry vans. It's because of the tender rejections, right? So what is happening is as more contract carriers reject that freight, it ends up on the spot market, therefore pushing those volumes up on the spot market. And we are following the 5-year average, and we're actually getting closer to the 5-year average right now, which is really nice. Now let's take a look at spot rates for dry vans. Yeah, for the past 3 weeks, they have been increasing. No surprise, the more volume, the more capacity is being soaked up, and therefore shippers and brokers are forced to start hiking those rates up because now there are not as many trucks to choose from, right? So they have to have a selling point. And again, we are following the 5-year average, which is nice, but it's good to see that dry vans are on their way up. I hope that for those dry van operators, this puts a smile on your face. So let's take a look at some maps. Now these maps are for the general freight market. They're not just for the spot market. And this is a map that shows us volumes. Now, as a reminder, red means the volume decreased from last week. This is in the whole market, right? This is not the spot market. This is the whole freight market. And the height of an area shows us total volume in the area. As we can see, for the most part, it's pretty red and gray, which means decreases in volumes for dry vans or no change. There are some areas in the south, in the Midwest, Michigan, some places in the East Coast, Idaho, Montana, where volumes did increase. But in general, not much interesting happening with volumes. What is interesting, and the reason there are more volumes on the spot market, is because of this. These are the tender rejections. And as a reminder, blue means the tender rejections are on their way up. More and more loads are getting rejected. The volume or the height of an area shows us total tender rejections for dry vans. The map is pretty much blue. Tender rejections for dry vans are going up. That is why there are more loads on the spot market and the rates are increasing. The highest increases in tender rejections are in Nebraska. I'm not even going to count Montana. We have Mississippi, Alabama, Georgia, Jacksonville, Florida, Virginia, Maryland, Delaware. We have parts of Wisconsin and even the West Coast. The tender rejections are increasing. This is the first time I see the dry van map or the map at all this blue. So this makes me really happy to see that the market is at least getting better for someone. Okay, now we have the head haul index for dry vans. And what this is it shows us which places have more loads than trucks and which places have more trucks than loads. If the place is blue, the darker blue it is, the more tight the capacity there. So it's the opposite of the flatbed map, right? Red areas show us that there is loose capacity. There are way more trucks than loads. So for dry vans, we can see California, it used to be just this sliver of California, but now it's kind of spreading. There is tighter capacity in Southern California. We can see that the Midwest is, it's okay. The Southeast is getting pretty interesting and the Northeast is getting pretty interesting as well. So let's take a look where you need to be relatively if you have a dry van next week. So this map shows us volumes versus rejections. The color shows us rejections. The bluer it is, the more rejections, right? The height shows us the volume in that particular market area. And what we need is we need places where it's very elevated because there's a ton of volume and extremely blue, preferably like Wisconsin, because that means that volume is getting pushed into the spot market, increasing the spot market volume and therefore increasing rates. So just looking at the dry van, I can see that Southern California is an interesting place and Texas, the Southeast is very interesting. There are portions in the Midwest as well. Virginia is becoming quite promising, but yeah, that's pretty much it. It looks much better than it did in previous weeks, which is really, really nice. Now, again, as a reminder, because I get this comment all the time under these videos, why are you saying these are good areas? Well, because they're relatively good. Does this mean that you're going to get, I don't know, $4 or $3 per mile out of the Houston area? Absolutely not. It just means that you're going to get a better rate from here than if you were in Colorado or in a place like Philadelphia, Pennsylvania, or in Maine, etc., etc. It's all relative, right? I'm showing you guys the markets with the best potential. But again, you guys make the decision. It's your business, your truck, your operations. Just check it against the load board and it will give you an idea. Check California against Utah and see the difference. That is what I'm talking about. Anyway, I'm rambling. Let's go ahead and look at some reefer data. Okay, reefer spot loads, volumes for reefers, they have been increasing, right? You can see, and it's following the 5-year pattern, which is nice, but they have been increasing because of those tender rejections, right? This is not skewed by the flatbed. This is just the reefer. So that is a pleasant surprise. Let's take a look at reefer spot rates. Definitely following the 5-year pattern. You can see the peak here, peak here. They have increased last week, which is really, really nice. The question is this 5-year pattern going to continue? And will the reefer rates decrease from here on out? That is a big question because produce season, it's muted, but it's also delayed. So it's possible, or there's a chance that these rates and volumes will continue increasing because of the delayed produce season. Produce season usually starts much, much earlier and ends much earlier. So we shall see. All right, let's look at some maps starting with volumes. Again, this is not the spot market map. This is general volumes. Reefers are not as interesting. As you can see, for the most part, the map is gray and flat, which means that volumes are, they're not changing by much. There are some red spots, there are some blue spots. The sad thing is that in California, there is no change. Although in Arizona, not in Nogales, but in Arizona, there's a little bit of an increase. In the Northeast, there's an increase in volume as well. But in general, it's it's kind of bland. Now, what about tender rejections? Well, much better map, still pretty flat. It's not as exciting as the dry van map, but we can see tender rejections are increasing in California, Washington, the Midwest, Houston, Texas, the Southeast. So that's nice. So the thing is, and I have heard this, is that when the market does start improving, it's not going to improve across the board. It's going to be fragmented, right? There are going to be good market areas and there are going to be bad market areas. It's not going to be like 2021 where no matter where you go, you're going to get a good rate per mile. You actually have to be strategic here. So it looks like the reefer market is improving in certain areas, but yeah, we shall see what happens in the next few weeks. Okay, now on to the head haul index. Again, as a reminder, blue is good. That means more loads than trucks. Red is bad, more trucks than loads. California, Idaho, portions of Texas, portions of the Northeast, and maybe some of the Midwest is where the negotiating power will be for reefers. But honestly, the more I look at this map, the more I feel like it's getting worse week by week for reefers in terms of negotiating power. Possibly over capacity or increased capacity for reefers, because usually this is the reefers time, right? And maybe people are getting into this market with reefers hoping to catch this produce season and make some money, not realizing that the market is just, it's not there at the moment. But yeah, I'm not sure I like the head haul index for the reefers. All right, where do you need to go if you have a reefer trailer next week? Again, we're looking for a place that is elevated, meaning a ton of volume, and as blue as possible, because that means a lot of rejections. California, Washington, the Grandview, Washington, and the Spokane, Washington markets. Idaho is dying. The Midwest is interesting. Fort Worth. And that's pretty much it. I'm not going to mention South Carolina because of how flat it is. There's no volume. But yeah, if we look at this map, we definitely see that while reefers have some areas of opportunity, they're not getting better across the board. It's just some fragmented markets, unfortunately. So if you're a reefer operator, you have to be very strategic in planning which lanes you're going to run. And again, as a reminder, this is all relative, right? It doesn't mean you're going to get some crazy load from California paying $5 per mile. It just means that you're going to get a better rate here than in Colorado, Utah, Ohio, Virginia, and places like that. But yeah, for reefer, it looks like strategy is everything. So there you have it, you guys. It looks like the market is starting to slightly improve for reefers and dry vans. Obviously for flatbeds, it's a completely different story. We definitely still have ways to go before the rates are survivable, but at least they're moving in the right direction. Now, recently I watched the Q3 prediction by Coyote. Now, I'm sure you guys are going to have your thoughts about predictions from a broker like Coyote, but it was interesting to watch. They obviously say that we're currently bouncing on the bottom, but what is more interesting is an observation they made with shippers. Shippers are doing more frequent bids in order to capitalize off the current market situations. For those of you who don't know, bids usually last on average a year, right? And that locks in the rate, and that rate is good for a year, usually. But what shippers are doing right now is they're asking for more frequent bids to keep up with the downturn in the market so that they can capitalize off the current situation and make some money. Yeah, at the cost of the carrier, of course. Now, another thing they said about shippers is that they are noticing that shippers are starting to take interest in what the capacity will be like for peak season. The thing that makes this very interesting is that they mentioned that this did not happen in 2022. Shippers were not taking interest in capacity for peak season, whereas usually they do, because peak season is the time where volumes go up, capacity is harder to find, and now they're taking interest in what is going on. So hopefully that is a sign of things getting better a little bit. Now, obviously and sadly, I do not have a crystal ball, and realistically, even if I did, I don't think it could predict the current market because of how crazy the freight market is right now. It's simply unpredictable for the most part. But you know me, I always have hope. Hope dies last. And I really hope that things start turning around in the next few weeks, especially for reefers and dry vans. Flatbeds are a different story because they're more seasonal. And as we move through the year, obviously the weather is going to be colder, construction is going to slow down, and that affects flatbed volumes and of course rates. Now, do I think that if the market starts flipping, it will be a rapid flip? Absolutely not. I think it's going to be a slow and torturous journey up, but at least it's going to be going up. Anyway, guys, thanks so much for watching and joining today. I hope you learned something new and useful for your operations. Wishing you all a wonderful rest of your week, and I'll see you guys Sunday at 4:30 Eastern. See you guys then.